Hi, I'm Lim Yuin, Chief Investment Strategist of Lion Global Investors. Given the market volatility and turmoil that we are seeing now, I would like to give an update on current events since we published our fourth quarter market outlook in September. While sentiment has turned bearish since, I still see selective opportunities in Japan, China, and Singapore. But first, let me summarize the key points to my market outlook. The key driver to equities prices globally is the policy changes at the Fed. This chart shows how closely the S&P 500 index and the MSCI All-Country World Index tracks each other. There was this strong view in the market in June that inflation in the US would peak soon and that the Fed would pivot, meaning that they would signal a more dovish stance and the US market rallied. However, when inflation numbers turned out to be higher than expected in August, the US market corrected. Likewise, we could see global equities following closely the performance of the US stock market. Our view is that inflation would peak, but the question is the pace at which inflation cools in the following months. Our view is that inflation will decline, but not quick enough for the Fed to U-turn and turn dovish over the next few months. So we view any rally in the US equities market to likely to be a short-term rebound, and that the weakness in the US equities market would likely be a drag on global equities. So where are the opportunities? The thesis in Japan is relatively simple. The yen has weakened to a 30-year low, which means that Japan could become very competitive in future. Not to mention the influx of tourists into Japan now that Japan has eased travel restrictions. China equities has corrected significantly since last year and valuations are now very attractive. That said, we still lack catalysts for the market. Recent developments also did not help. The new advanced semiconductor technology export restrictions to China, announced by the Biden administration on 7th October, would significantly negatively impact the semiconductor industry in China. As such, the Chinese tech sector could face headwind till we see mitigating factors by the Chinese government. The 20th China Party Congress is still ongoing as we are recording. The message so far is neutral and could have been better. As a start, there are no indications that China would exit the zero-COVID policy, which, if they did, would be a major catalyst for China equities. That said, we do not see any surprises as comments are generally market neutral as they suggest continuing with current policies. Finally, we see Singapore equities as a defensive play in a world with greater volatility. Singapore's openness and success to transition to a post-COVID world has made Singapore the preferred financial hub in Asia, and that the Singapore market will be defensive with the funds flowing here as investors look for a safe haven in these uncertain times.